Good morning, everybody, and welcome to our March IFRS and Corporate Reporting webinar. Now, as you all know, our IFRS platform is fairly stable at the moment, which is fantastic news. We've dealt with IFRS 9 and 15 and 16 over the last few years. We've dealt with the IFRIC interpretation around SAS, customization, configuration cost. So the real big change that is heading our way is IFRS 17 around insurance contracts. And really important to know that IFRS 17 insurance contracts is not only applicable to insurers, but it actually applies to all insurance contracts, insurance clients, non-insurance clients, etc. Today's webinar, we're not focusing on IFRS 17 for insurance companies. We're actually focusing on the implications of IFRS 17 for non-insurance insurers for corporates. So welcome to this webinar. It's a really important and topical topic to start to think about and get ready for. And to do this presentation, we've got Dean Ardern. Now, Dean is in our IFRS and corporate reporting team and a very valued and senior member of our team. And Dean worked at the AASB with me many years ago and always looked after insurance, looked after superannuation way back when in the day, Dean. And therefore, I'm very happy to hand over to the very capable and knowledgeable hands of Dean to do the presentation today. But welcome, and we hope you find it very informative.
Thanks very much, Aletta. A very generous welcome. Thanks for that. I might press straight into the presentation because I know we're all sort of time poor and we've scheduled only an hour for this. I've tried to cut down this presentation and make it as concise as I possibly can to what I imagine the audience to be, and that is corporate entities. And so I've been focusing on those entities as a basis for this presentation. So this is not a comprehensive presentation on IFRS 17. It's really just focused on the aspects of IFRS 17 that are going to be most relevant to those corporate entities that might be issuing insurance contracts. You can hear me fine, Aletta? Everything's coming through? Excellent. All right.
Dean, so we can hear. I'm still on the first slide. You haven't moved the slides, have you?
No, I haven't, but I'm moving them now, so we'll start pressing through.
Yeah. All right, fantastic.
So rather than dive into the detail from the get-go, basically what I wanted to do is to step back for a moment and talk generally about the different risks that different types of contracts expose entities to. I think, and then turn talk about how those impacts, how those contracts that have been classified, how that impacts that classification under accounting standards. And I think that might be helpful just to maybe to contextualise our discussion around insurance contracts. So in the broadest sense of the word, risk is the possibility of loss or injury. So in essence, risk is the possibility that the future won't really turn out as you expected, which really means it won't turn out as you hope for. And consequently, you'll suffer a loss in the form of a loss of maybe an asset, a loss in the value of an asset, the requirement to pay additional liabilities and so on. So in an attempt to mitigate the risks that they're exposed to, what you often find is that corporate entities will adopt a range of strategies and arrangements and policies. Now, in a lot of these cases, these strategies and arrangements and policies, they really aim to deal with financial risks. Now, in this slide, what I've tried to do is provide some examples of what's generally regarded as financial risks, and they're on the left-hand side there of the slide. Now, they include exposure to things like changing market prices, variable interest rates, variable foreign exchange rates, and credit ratings. Now, to deal with these risks, entities will often enter into arrangements that normally are classified as financial instruments, such as put and call options, forward and future contracts, interest rate swaps, options, loan guarantees. They go on forever, really. In some cases, however, these strategies, arrangements, and policies expose companies to insurance risks, and I'll discuss in more detail later in this presentation, but when an entity enters into an arrangement to protect itself for another entity, and that when I'm thinking of other entities, I'm thinking of maybe subsidiaries as well, from risks that are not in the nature of financial risks, and I've described these types of risks in this slide as non-financial risks, and I've given a few there on the right-hand side of the slide. they're potentially moving into what are insurance risks. Now, on the right-hand side of the slide, I've provided some examples, some specific examples, so things like damage, floods, fire, things like obsolescence, key person risk, public liability. And what you often find is that entities are exposed to and they sometimes seek protection from these types of risks. But they also, from time to time, also actually provide other parties, so other parties protection from these types of risks because of the nature of the arrangements that they're entering into with these parties. So what I've tried to do in this slide is really to extend the previous slide by categorizing the typical contracts and transactions an entity might be involved in based on whether they deal with financial or non-financial risks. So I've sort of tried to categorize those financial risks and the types of instruments you see there on the left-hand side against financial risks, and then the non-financial there on the right-hand side. As you can see from the left-hand side of the slide, the types of transaction and contracts that mitigate financial risks include things like options, forwards, futures, interest rate swaps, hedge arrangements. In accounting, we always normally classify these transactions as financial instruments, and we account for them under IAS 32 or IFRS 9, depending on the nature of them. Now, on the right-hand side, I've provided a range of non-financial risks to which a typical business might be exposed. And the normal types of responses we see in these businesses to these risks, including taking out insurance policies to cover key risks, maybe investing in disaster recovery arrangements, maybe diversifying geographical locations, kinds of physical things you might do, but also transactions you might enter into. Now, I think the key takeaway from this slide is that financial instruments can both expose you and protect you from financial risks, whereas there's a range of contracts and arrangements that both expose and protect entities to and from non-financial risks as well. But I think one of the key ways in which entities always protect themselves from non-financial risk is by using insurance contracts. Now, when we think of insurance contracts, we typically think about those contracts that entities buy to protect themselves from risks, so they're a policyholder in that situation. But what I really want to turn to now is and turn your minds to is the ways in which other parties might seek to protect themselves from non-financial risks that maybe you, your entity, your clients expose them to, and how that behaviour manifests itself in the contracts and arrangements that you have with those entities. So what I'm trying to do is flip your mind and start thinking, okay, I know I've got insurance contracts to protect myself from risks, but what are other entities doing? How are they contracting with me in a way that might actually be me providing them with protection from certain things which might otherwise they would perhaps seek protection from by maybe buying insurance contracts? Now, the kinds of behaviours I'm thinking of are, and these are commercial behaviours we see every day, include things like seeking warranties, maybe requiring you to take out performance bonds, maybe requiring you to make guarantees. I'd like now, Aletta, I'll just like now to actually do a couple of the quick polling questions if we can. And what I want to use is these polling questions to gauge where you think maybe your employer, or particularly whether you think where you are in terms of insurance contracts, and whether you think you're writing these contracts.
Dean, I might give a bit of feedback on how we're going with the polling.
Yeah, if you would. Yep, that'd be great.
So people are thinking about it and they're starting to vote.
Okay.
I would say nearly half of all our attendees, we've got hundreds, Dean, have actually voted. So maybe we give them another few seconds,
yeah, for sure.
and then we'll close the poll. I'll just give it a few seconds. All right, Dean, are you happy for me to share?
Yeah, absolutely. Yep.
So we'll close that one and we'll share it. Can you see that one, Dean?
No, I cannot. Maybe that's me.
Okay, so maybe I'll just, I can see it, and hope the others can. Question, does your company or client write any insurance contracts for other parties, including related parties, subsidiaries? 23% the people who voted said yes, and 77% said no.
Okay, so approximately 1/4, 3/4.
Yes, absolutely.
Okay, it's interesting.
So the next question, how confident are you in your response to question 1? So I think what Dean's trying to do here is just get a little bit of a lay of the land before we explore a little bit further. He's asking how many of you were very confident, reasonably confident, not reasonably confident, or not confident at all, which will give us a good idea before we explore further. So thank you very much for everybody that's participating. It always gives the presenters a good feel for the depth that's required. So thank you very much. Dean, I'll share that one.
Okay.
So if you can't see it, very confident, 27%. Reasonably confident, 52%. Not reasonably confident, 18%. And 3% said not confident at all.
So it's almost the reverse. So there's 3/4 of the listeners don't think that they're issuing insurance contracts, and it sounds like 3/4 of them are fairly confident of that too. So presumably it's the same group.
Correct.
Yeah. Okay. That's interesting. All right. We'll press on. I'm going to come back to those polling results in a minute, but first I want to introduce the new accounting standard on insurance contracts, IFRS 17, and discuss the entities and the things that it'll apply to when it becomes mandatorily applicable. So although IFRS 17 was developed with registered insurers specifically in mind, over the past 12 months, Aletta and I have come across a number of entities that aren't registered insurers, but are actually issuing what are insurance contracts to other entities. Now, because they're not registered insurers, they have taken the view that IFRS 17 doesn't apply to them. Consequently, my focus today is actually going to be on corporate entities that might actually be issuing insurance contracts. Now, whether that's advertently or inadvertently, that's another matter. But I'm going to look at that, but also the implications for those entities that are doing it. Now, that's not to say there's nothing in today's presentation really for those who are regulated insurers, but I think it's important to contextualise that today I'm really talking to non-insurers about IFRS 17. So I'm really narrowing the focus of sort of the areas that I want to talk about. There's lots of aspects of IFRS 17 that obviously would apply to the regulated insurers who have more broader insurance contracts and maybe insurance operations. So it's not going to be for those who are from a regulated insurance background, this is going to be a fairly potted introduction, but there'll be stuff in there that you probably get something from for sure. Now, focusing on what we'll cover today, my aim is really to give you a high level introduction. Now, I'm going to consider the typical arrangements that corporates might be involved in and are not involved in, and maybe they'd considered to be insurance contracts. And I'm going to use some practical examples to explain how corporate entities that are parties to insurance contracts should actually account for these contracts. So let's get into IFRS 17. First thing, absolutely to be clear about, IFRS 17 applies to entities that issue insurance contracts, which means it presumably will apply to entities that are registered insurers and whose business is to sell insurance contracts, but it's actually going to be applicable to those entities that are not registered insurers, but are issuing insurance contracts. Now, I've provided a very brief list here, but what I wanted to do was to actually now make you think about the actual transactions that you think might be involved in and whether or not they might be insurance contracts. Some of the types of promises that we see that potentially give rise to insurance contracts are here listed on this slide, and they include things like performance bonds. These are effectively securities against the failure of a party to an agreement to meet its obligations under the agreement. Now, what we typically see is entities treat these deposits that they make as an asset, but they actually don't impair the asset, or they don't recognise the liability in respect to any changes in the possibility that it might actually not meet its obligations under the arrangement. Other types of insurance contracts potentially are warranties issued in respect to products not sold by the entity. You might say to yourself, well, hang on, when would it issue a warranty in respect to a product it hasn't sold? We do see it pretty regularly within groups of entities. So you might find that one entity might have sold the product, but another entity within the group has actually sold the warranty that goes with it. And so it's dealt with a different part of the group of the seller. But when they do that, if at any point in time an individual entity has to produce separate financial statements of their own, particularly the entity that's selling the warranties, it's going to have to account for those warranties as insurance contracts. What else have we got? Indemnities issued to a participant in legal proceedings in relation to court costs that might be awarded against them. We do see that in some particular industries, in the legal industry, there are some entities that are doing this. You might also find this in corporate groups where one entity will agree to another party or another entity within the group actually paying those court costs or agreeing to pay those court costs, or at least reimburse them for the court costs if they incur them because of the way that the court case is set up. Other arrangements we see that are potential insurance contracts are indemnities issued by vendors in the sale of a business or an asset. It's really common to see in those sort of arrangements where entities are saying to the buyer, look, I'll give you an indemnity. I'll actually, I'm representing to you that this thing works or this thing operates properly, and if it doesn't, I'll do something about it. Loans issued with a waiver for the death or unemployment of the borrower. We see those typically in arrangements where the fundamental business of the entity is to lend money, but we're also seeing that now in fintech sort of arrangements too, where entities are getting on a lower scale, are actually issuing loans to customers, and in doing so, contractually they're setting themselves up to create insurance arrangements by making certain promises that they won't pursue debts if, for example, the borrower dies or becomes unemployed. We see guarantees of minimum quantities, so things like outputs, revenues, or profit, particularly on outputs. We might see that amongst the mining industry, but we might see that in other areas as well, usually related to physical product. And the last one on the list there, self-insurance. Again, it's usually within a group. So typically there might be an entity within the group that actually insures certain aspects and certain risks that the group is exposed to, and therefore provides policies to other entities within the group. If that entity on its own has to produce financial statements, then it has to actually account for that self-insurance as insurance arrangements. When it comes to the wider group, it won't be accounted for as insurance because you can't be both the policyholder and the insurer at the same time. But when it's dealt with at the individual level, then it can lead to accounting for insurance. So now I've given you some more explicit guidance on what might and might not be insurance contracts under IFRS 17. I want to ask you again the polling questions I asked at the start of the presentation regarding whether you think your entity or your clients might be writing insurance contracts and how confident you are in that assessment. So Aletta, could I get you to load up those next set of polling questions?
Dean, the question is up. At the moment, we've got about 40% of attendees voting. We'll see if we can get a few more before I close it and share the results. You'll find this one interesting, Dean.
Will
if I close it, yeah. Remember previously only 25. Now we're saying just after that one or two slides, about 43% are saying, hang on, we think we might have insurance contracts, and 57% still saying no. And then I suppose you want me to do the next one again, and that is how confident you are.
Yes.
That's right. Let's just do a little bit of maybe people are more confident about their answer, maybe less confident now thinking about it a bit more. Maybe you've just created confusion, Dean.
Yeah, okay, maybe I have. My apologies.
So let's see. thank you everybody for participating.
Yeah, thank you.
All right. So, Dean, really interesting. If I share these results, the very confident is 25%, reasonably confident is 55%. So I reckon confidence has maybe grown from the previous one. And then not reasonably confident is 18%, and non-confident at all is 2%.
So it stayed about roughly
I have to retract my comment. You haven't created confusion. You've created clarity in 2 slides already.
That's good. Well, but it increases, obviously, you know, saying the results, people indicating that they are reasonably confident that they now do have some insurance contracts. So that's an interesting outcome. We might press on, just obviously conscious of time. What I wanted to do is just have a quick discussion around, and I suppose the best way to title this discussion is, why does it matter? When we, you know, from time to time when we do come across entities that have issued what would otherwise be insurance contracts, but they haven't accounted for them as obligations arising from contracts, they've actually typically accounted for them as provisions. Now, when we encounter this type of situation, the entity we're normally talking to will say to us, well, why does it matter? If I account for it as an insurance contract or provision, I've still got something on my balance sheet, I'm still recognising a liability, and particularly in cases where there's no premiums involved. So there's no asset for the premium, it's just purely a liability, which is a common feature of lots of insurance contracts with corporate entities. So the question's then asked, well, why wouldn't I get the same number under IAS 37 for a provision as I would get under IFRS 17? And therefore the implications are, you know, well, you know, why you're telling me I'm not applying the right accounting standard, but my numbers are not going to be any different. Maybe I've just not labelled what the obligation is correctly. Maybe that's the problem. Now, the short answer to this, and even when there's no actual premiums to change hands, there's a number of significant differences between the requirements in IAS 37 and IFRS 17 that not only can produce different accounting numbers from the obligation, but the differences also impact the timing of the recognition of the obligations. And really an interesting thing is around the thinking that the entity goes through in order to assess the materiality of the transaction, and therefore whether they actually need to recognise anything. So I've broken it down into sort of 3 high points, and we'll cover those now. If we start with the initial recognition criteria in IAS 37 and IFRS 17 and consider what are the implications of applying these 2 sets of recognition criteria basically to the same obligation, the first thing you should note that's under IFRS 17, the obligation is likely to be initially recognised at an earlier date than what it would be under IAS 37. Now, if you think about that, that makes sense anyway too in the idea that, look, IFRS 17 is written for insurance companies, and so when they write a policy, you would expect that that policy would hit their books at pretty early in the piece. You know, we wouldn't expect there'd be a delay in terms of recognition. And the reason is the recognition criteria in IFRS 17 is actually very similar to the corresponding requirements in IFRS 9 for financial instruments, in the sense that IFRS 17 requires an entity to recognise an insurance contract when it becomes a party to the contract, which implies that the insurer is actually potentially on risk from the moment they sign up to insure the customer. And this is generally, though, where the similarities end. So typically coverage period, coverage under an insurance contract will actually start when the coverage period starts, or when the first premium is received. But there might be circumstances where an insurer might actually write an insurance contract that's actually onerous on day one, which is unusual, but it does happen. And the IFRS 17 is conscious of that. So it says that if, for instance, the policy attracts no premiums and is therefore onerous, so you're only just assuming an obligation, you're not getting any benefit from any premiums, then it's likely that you'd have to recognise it on the date that you actually become a party to that contract. Now, if you compare these recognition criteria to the corresponding requirements in IAS 37, the initial recognition date under IAS 37 could actually be very much later as compared to that under IFRS 17 for a variety of reasons. For instance, on the date the insurance contract's signed, it might be concluded that, hey, it's not probable that there'll be an outflow of resources in the future. You know, this might be a court case maybe, or a provision around something which I'm not sure what's going to happen in the future. Or alternatively, you might not be able to make a reliable measurement of the amount of the obligation. So under IAS 37, you might get a much more delayed recognition timing. Now, note that IFRS 17, the recognition criteria doesn't talk about any of those things. It doesn't talk about probability. It doesn't talk about reliable measurement. It just simply says, effectively, when did you become on risk for the arrangement, and that really brings that timing forward. And so you'd expect that under IFRS 17, you'd expect that obligation would appear much earlier in an entity's financial statement than it would under, say, IAS 37. Another difference is that, and it's a really significant point of difference, is the measurement. So the provisions are measured at the best estimate of the expenditure required to either settle the obligation at the year end or pay a third party to take the obligation off the issuer's hands. Now, typically entities might struggle to find a third party to take a written insurance policy off their hands, primarily because people generally don't like buying liabilities. And the reason is they often don't like taking on something they don't know what has happened to. So they don't know what the other party has promised. They don't know what you promised as the obliger. So as a consequence, it's often very hard to find a third party. So at best, from time to time, you see large insurance policies in portfolios actually traded, but you don't actually see often individual contracts traded. So the carrying amount under IAS 37 will probably reflect the amount of money the entity could offer the insured to cancel the policy at the end of the reporting period. Now, when you measure reliability this way, you're effectively excluding all that variability that in cash flows that that'll eventually work their way through the policy in the future, if you to actually hold that policy until its maturity. Now, in addition to requiring the liability to be measured at its best estimate, actually implies it's a mean expected value. I'm not going to go into the stats, but the idea is that when you start talking about insurance risks, you start to have deviations from means. And by treating the liability at a mean or an average, it actually ignores all the risks associated with potentially skewed distributions in the future. So if you compare those requirements now to, say, an insurance contract measured under IFRS 17, the assumption is that the insurer will actually fulfil the obligation to the end. And so there's no expectation that they're going to be able to either sell or necessarily close out the contract early. So that liability number is going to reflect all of the variability in the cash flows over the life of the policy. And to that extent, what the insurer is going to have to do is actually include both a risk adjustment for financial risk, which reflects the risk the entity is exposed to as a consequence of agreeing to be basically liquid for the term of the policy, as well as a risk adjustment for non-financial risk, which is actually reflecting the risk that the entity is assuming. There'll be changes maybe in the prices in the future related to, say, administering, managing, and settling any claims. So as a consequence of that, you get a very, very different measurement. The numbers look very, very different because they have very, very different measurement requirements to them. There's one more issue that I really want to just highlight here too, and it's an interaction between that recognition and measurement requirements in IAS 37 and IFRS 17. Now, because of the way in which recognition criteria in IAS 37 are actually described, an entity could actually conclude an amount need not be recognised in their financial statements in respect to an obligation because it's actually not material on the basis that either it's not probable there'll be an outflow of resources or maybe they can't reliably measure it. Now, under IFRS 17, once an arrangement is identified as an insurance contract, the only way in which an entity will know whether it has a material obligation is actually to measure the obligation. So when we talk to entities that have incorrectly maybe classified an insurance contract as a provision, but not recognised amount of an obligation in their financial statements, their response is usually because the measured amount's not material, but that conclusion is actually based on the application of the wrong criteria. So they haven't actually gone through the process of measuring it under IFRS 17 to determine whether it's material or not. They've used the criteria in IAS 37. So as a consequence, they don't have anything on their books. Probably the last one, but this one I think might be fairly self-explanatory, is the level of disclosure around it. And I just did a quick survey of the two financial accounting standards last night. So the disclosure requirements in IAS 37, there's actually only 9 paragraphs in total in IAS 37 dealing with disclosure, and they're all contained on one page of the standard. Whereas if you actually go to the disclosure requirements in IFRS 17, there's actually 39 paragraphs, and they're spread across about, I think it's about 6.5 pages. So I think those stats speak for themselves. I think when you start getting into the detail, you realise that IFRS 17 is much more detailed too in the terms of information required. So let's jump into an overview of IFRS 17. I've only got a limited time. Like I said, I'm going to really go through this in a sort of a very, very high level. But I'm going to focus on the scope requirements, and I'm going to focus on some of the measurement requirements too, and particularly the ones that are likely to be relevant. Just to give you some context, IFRS 17, it applies from 1st of January 2023. It's actually, for those that are 30th of June reporters, what that effectively means is their first reporting period under IFRS 17 is going to be the 30th of June 2024. But for December reporters, the first reporting period is going to be year ended 31st of December 2023. So it's coming up. It's important that if you need to be prepared for it, then obviously you need to be in a position to be able to deal with it. There are three effectively, well, I suppose I've contextualised this is that for those of you who listened to me in the past when I talk about accounting standards, one of the things that you might have heard me talk about scope and definitions. In the context of accounting standards, scope and definitions go hand in hand. So at the start of every accounting standard, there's actually a scope paragraph that explicitly states what items, things, events, transactions, whatever they are covered by the standard, and therefore implicitly or explicitly what items are therefore outside the scope of the standard. Now, when something's identified as being within the scope of the standard will then provide a definition of that thing. Now, the definition will identify all the definitional criteria a particular item has to meet to be classified as within the scope of the standard. So obviously, if an item doesn't meet the definitional criteria, then it's going to be outside the scope of the standard. Now, in this slide, what I've done is I've identified probably the key definitions to the scope of IFRS 17. So although IFRS 17 includes some scope exemptions, let's just assume at this stage that there are none at this stage. So at the top of the slide, I provided a definition of the insurance contract, which is a contract under which one party accepts significant insurance risk from another party by agreeing to compensate the policyholder of a specified uncertain future event. The insured event adversely affects the policyholder. Now, as a part of that, it includes, and that definition obviously includes risk. So risk in the context of insurance risk is other than financial risk, which is transferred from the holder of the contract to the issuer. Now, I've given a definition of their financial risk. I'll come back to that. It's not critical at this point, but it's relevant as we go forward. The last key bit is the idea of the significant insurance risk. So insurance risk is significant if and only if an insured event could cause the issuer to pay additional amounts that are significant in any single scenario, excluding scenarios that have no commercial substance. Now, when you read that, I'll get you to just cast your mind back to the previous slide when we were talking about provisions and the idea of reliable measurement. This criteria is moving straight past reliable measurement. It's not even asking you whether you can reliably measure something. It's just simply saying, is there the possibility in all commercial circumstances that you might have to pay out more money than you expect? And if you do, you've got an insurance contract. And so this is why that criteria, when you apply the IS37 criteria, it doesn't quite work when you're trying to work out whether or not your insurance contracts are material or not. Now, in this slide, I've provided all of the scope exclusions. Now, the key ones that you probably need to be aware of is warranties provided by a manufacturer. So all of these things, the dot points there, all excluded from the scope of IFRS 17. So they're dealt with by another accounting standard somewhere else. So warranties provided by a manufacturer, dealer, or retailer in connection with the sale of its goods or services to a customer. Note that I mentioned previously where an entity sells warranties in relation to goods that it itself doesn't sell, that is actually an insurance contract. But in a situation where you sell a warranty with the actual good, the entity does the same thing, then it's treated as part of the revenue contract. Residual value guarantees provided by a manufacturer, dealer, or retailer, and a lessee's residual value guarantee embedded in a lease, so that's dealt with either under IFRS 15 or 16. Financial guarantee contracts, these are a bit tricky, but they are often generally accounted for under IFRS 9 because entities will say that they're going to be accounted for under IFRS 9. But if you haven't said, you've got financial guarantee contracts. A financial guarantee contract might be something like whether a parent agrees to cover the debt of a subsidiary if the subsidiary fails to pay on time. That's a financial guarantee contract. If you haven't specified that that's actually a financial instrument, then it has to be accounted for as an insurance contract. Contingent consideration, payable, receivable, and business combination, that's dealt with under IFRS 3. And insurance contracts, when the entity is actually the policyholder, not the issuer, then that's dealt with by another accounting standard, but not IFRS 17. There's a couple of accounting policy choices in this standard, and really they relate around IFRS 15, 17, and 9. And the reason being is that these things sort of have features of both. So, for example, fixed fee service contracts, so imagine your RACV or RAC New South Wales, RAC Queensland membership, can be accounted for under IFRS 15 or IFRS 17, subject to certain criteria. Credit card contracts, where basically that the price that the holder of the credit card isn't actually charged based on their individual risk, then that can be treated under IFRS 9, or can be treated under IFRS 17 if you choose. And loan arrangements where there's some default arrangement in there, that can also be treated under IFRS 9 or 17. So I think the key, and I'm jumping through because I think these are probably the most important parts of the presentation. So it's really, the question is, do I have an insurance contract or don't I? And I think the best way to view this slide is, and the next one, is as a partial checklist to consider when you're evaluating agreements, whether they're within the scope of IFRS 17 or not. Now, the first definitional feature there is the existence of a contract, which is normally regarded as an agreement between two or more parties. It creates enforceable rights and obligations. Now, for accounting purposes, we also acknowledge that contracts can be written or oral, implied by an entity's customary business practices. Now, the main upshot of this is that if an arrangement whereby one party agrees to compensate another party for the loss they experience as a consequence of specified uncertain future event actually arises from legislative or other legal requirements, it's actually not within the scope of the standard. So it actually has to be a contract, not a legal requirement necessarily. And that's important to remember, because if you're doing things because of legal reasons, by legislative purposes, then that in itself is not an insurance contract. It has to be a contract between parties. When we consider contracts for accounting purposes, we also need to disregard any contractual terms that have no commercial substance. So if a contract confirms that a holder will be compensated in the event that they suffer a loss or a consequence of a future event, which there's absolutely no chance of happening, or no chance that they're going to suffer a loss from, then you need to sort of consider whether or not that's actually an insurance contract, or whether someone's getting paid for something else. You know, is there some other purpose for this payment? And again, in terms of the next criteria, there has to be, at a minimum, there has to be an issuer and a policyholder. Like I mentioned before, the idea that if two entities within the same group insure each other, then individually, they're probably involved in insurance contracts. But if we do it as a group account, so we prepare consolidated accounts, there won't be any insurance contracts, because the insurer and the policyholder are the same entity. And compensation. So compensation could just mean anything. It could mean relief from debt. It could mean cash. It could mean payments in kind. It could be any kind of valuable consideration. Uncertain future events. When you're considering whether a future event's uncertain or not, you need to consider the likelihood, and you need to consider in the context of the likelihood of the event occurring at all. Consider the uncertainty around when the event might occur. So there's the uncertainty of the event occurring during the term of the insurance contract or not. And the uncertainty as to the amount of the compensation that must be paid. So some events which you insure we know are going to happen. The question is, are they going to happen during the term of the contract or not? The last two features, I think what I might do is I might explain them by virtue of some additional slides, which I think examples are probably the best way to do. So understanding what's the difference between financial risk and insurance risk, we've got two examples. One, Company A agrees to compensate Company B for loss in the residual fair value of a vehicle belonging to Company B as a consequence of the vehicle being damaged by fire. Now, this is insurance risk. Okay, it's important to make that distinction, because it's about a loss as a consequence of a specified event that's unrelated to financial. It's a physical loss. So the vehicle's being physically damaged, can't be driven anymore, so therefore that makes it insurance loss or insurance risk. Example two, Company A agrees to compensate Company B for any loss in the residual value of the car, but excluding changes in the fair value attributable to changes in the physical condition of an out due to, for instance, fire. So that in itself is actually a financial risk, because what you're doing is you're saying to somebody, the average price of this car should be X on a certain date. If it's not, I'll give you some compensation for it. And if we go back to those definitions of financial risk, we're dealing there with indices of prices, really. Now, the other thing that we've mentioned before was the idea of the significance of insurance risk. So insurance risk is really significant if and only if the insured event could require the issuer the contract to pay additional amounts. Now, accordingly, insurance risk can be assessed by significant despite it being extremely unlikely. It could be that the present value is not very large relative to the value of the contract. It could be that the actual insurer totally reinsures the arrangement, or it might be that there might be no expected loss. So, for example, the contracts are very profitable. Now, in those cases, all of those cases, then you would say that notwithstanding those features, it's still an insurance contract. Notwithstanding, you might say, again, look, materially, nothing else is going to change. It's still an insurance contract and still caught within IFRS 17. And it also has to adversely affect the policy holder. Now, the importance to that is that really, if it doesn't adversely affect the policyholder, it means it could be a gambling contract. And most accounting standards don't really want to account for gambling contracts. They want to just account for the substantial commercial contracts which relate to specific events. I'm conscious of time, so I might just, I'm just thinking I might just skip through some of these slides and go straight to the key terminology. I mean, you've got the slides and you can have a look at it, but the key terminology, these are the three features of an insurance contract. So you've got fulfillment cash flows, you've got a risk adjustment on non-financial risk, and you've got your contractual service margin. I haven't mentioned contractual service margin before, but what that means is it's actually the embedded profit within the contract. Now, again, corporate entities, if you're issuing insurance contracts for no premiums, then there's not going to be a profit element in there. It's just going to be a loss element, and you need to recognise that usually up front because of the notion that they're onerous contracts. But if I go through and maybe I'll push right through to I think the slide that's probably best describes it. Actually, I just meant, just as an example of this one, I'll just mention fulfillment cash flows actually include all sorts of costs that are related to the actual contract. So it might be costs incurred to acquire the contract, the premiums specified in the contract. So we're talking about inflows and outflows here, not just outflows, but inflows as well. Other costs, incurred claims, future claims, handling costs, things like you can actually allocate some fixed and variable overhead to fulfilling those insurance contracts if you've got some management in those contracts, and maybe some potential cash inflows and recoveries if that's a part of the contract. If I push through to the key slide, and I think this is the key slide for my mind, because what it does is it shows you how these bits and pieces go together. It's a really weird accounting, and once you've got your head around it, it all makes sense. But the first thing you've got to realise is the idea that when we're building this, and this is based on the general measurement model in IFRS 17, when we're trying to work out the actual value to measure an insurance contract is, we're taking a building blocks approach, and we're actually putting together the building blocks. Now, the first set of building blocks is the present value of the future cash flows. To that, we must adjust for the risk adjustments for the financial risks as well as for the non-financial risks. Now, typically in this diagram, what's happening is there's actually an insurance asset. Now, typically with an insurance asset, what you find that the risk adjustments would reduce the carrying amount of the asset, but for the purpose of perhaps demonstrating this, we just said, look, you just add them in that sense. But when we put them all together, if we get the value of the asset to be 100, what we notionally have to do in our accounting is to actually set that 100 to be the contractual service margin. So what will happen is we don't actually recognise an asset on initial recognition of an insurance contract. On the other hand, if we have an owner's contract and we've got a liability up front, we will recognise the loss. And really the explanation for that is that lots of accounting standards actually will have a proviso in them that says you can't recognise any day one losses, particularly when you have to estimate the numbers. If you have to estimate the numbers, then you really shouldn't be recognising a day one loss, because there's a bit of uncertainty about how you got to those numbers. Those estimates might not be truly market measures. If you've got a market measure, which implies a day one loss, typically we'll recognise a day one loss. But when it comes to actually, or day one gain or loss, that is, but when it comes to onerous contracts, the standard's very clear in saying that, oh, no, if you've entered into an onerous contract and it's going to cost you money, and you've estimated it's going to cost you money, you have to recognise that loss up front. To demonstrate how that sort of works in a practical sense, I've given you an example there. I think the best way, and I find the best way with all these examples is probably to sit down afterwards and just work your way through the numbers. Now, I haven't given you all the numbers here to work your way through backwards through the example, but the key thing that I wanted to demonstrate with this is the idea that how it works. Like, so how do the bits and pieces interact with each other? So I've given you some. There's a background information there, some assumptions and so on. I was going to say too that if as a consequence of reading through this, you decide that you do need some pet insurance, please don't ring BDO. We don't sell pet insurance. We're happy to do the accounting for you for your insurance contracts, but we don't do pet insurance. But anyway, so when you focus on this, looking at the example and working your way through the various pieces of it, I think it's relatively straightforward, but it will take you a bit of time to do it. But what I'll do, rather than try and go through it here, I'll leave for you to go through it. But But I think what I'll do here is maybe point out some of the things that you might actually get caught up on that might be helpful if I explain now, so you can actually, when you do go through it, you can actually work out what they mean. So when I take all of those assumptions and that information and I put it into basically a present value calculation, they're the numbers I get. So you can see there in the third column there, I've got the present value of the estimated cash inflows. That's the premiums. I've got the present value of the estimated cash outflows. That's just the pure claims and costs. I've got an estimate of the present value of the net future cash flows there. That's in 1, 2, 3, 4, the fifth column. In the sixth column, I've calculated the risk adjustment for non-financial risk. In this example, I've just assumed that there's no risk adjustment for financial risk. It's just all non-financial risk. And as a consequence of that, when I add those things together, I get the fulfilment cash flows there at the end. Now, the total present value of the fulfilment cash flows is 5,719, and that's what I make the fulfilment cash flows to equal. That's what I make the contractual service margin to equal, because the idea is I've got an equal and offsetting, I've got an asset, but I can't recognise a day one gain. So what I do is I assume the contractual service margin, the embedded profit in the contracts, is the 5,719. Now, I've given you some, there's 4 or 5 tables here that basically sort of give the numbers, but what this table is effectively showing is how you get to the point where you actually recognise a zero for the insurance contract on initial recognition. Now, I think maybe if I go through this table, that's probably the one that's going to be of most advantage to you. So imagine the situation, opening balance, the day, 1 second on the day of the insurance policies were sold, there's no asset or liability, but then on the second of that day, we've got an insurance contract. But when we do the calculations, we can see that we've got the present value of the future cash flows is 6,672. That's just the cash flows. That's inflows. But I've also got outflows of the risk adjustment of 953, and I've got the contractual service margin of 5719, which gives me a zero balance to start with. During the year, I received $9,000, and I'm just to contextualise, I'm actually just looking at that last column there. I'm just working my way down that last column. I've got cash flows of $9,000. That's the premiums I get for the year. I've got insurance finance expense. That's my liability unwinding. So that's my discount in my unwinding of my liability, 1,287. I've also got unwinding of cash inflows as well. So I've got I've got future revenues in the form of premiums, and I unwind those because I've present valued those, and I get an income of 837 from that. Now, the changes related to the current service, now what they relate to is basically the fact that I'm unwinding risk. Now, because everything was assumed to occur as in accordance with the assumptions, what happening is now is I'm actually de-recognising part of that risk adjustment, because I've gone a year, nothing bad's happened, everything worked out as I expected, so I can unwind some of that 398. The total 953, so I'm unwinding 398, but I'm also going to unwind some of my profit margin as well. Now, typically with these sort of contracts, the profit margin is unwound on a straight line basis. The numbers are not going to quite look the same, but because there's some discounting going on, but it is effectively straight lining. And then at the end of the year, I make the payments, claims, and expenses of 7,000, which leaves me with a closing balance of 51. Now, the remainder of those slides really do. They really do follow that same procedure. So you can see with how the numbers unwind. The key part is to remember that when you get to the end of it, everything should balance to zero. You know, if you've paid out all your claims, if you're no longer on risk, then you should getting down to zero balances for everything. If that's not the case, then obviously something's gone wrong. So either the period of coverage is not complete, or something's happened that you still haven't paid out any claims. So there might be something going on there. I just want to contextualise that example with how that might apply in your circumstances. So if you're a corporate entity looking at this and saying, okay, well, it sort of looks, I mean, not in pet insurance, for example, but it sort of looks like what I'm doing, then, you know, how is it different? You know, how do I modify this model to sort of think about my particular circumstances? And there's a couple of things I think you should note. So in applying IFRS 17, there might be, in a corporate setting, might be some difficulties establishing what the contract boundary is. Now, the purpose of the contract boundary is to determine what the cash flows are that you use to calculate the asset or liability. And the reason it might be a problem is because often these arrangements between related entities are informal, they're not documented, so it's not clear what the term of the the contract might be. It might not entirely clearly identify what exactly is being, what part of the risks are being covered and not covered. And in that case, you probably find that you wouldn't be able to apply the premium allocation approach. Now, I haven't talked about that in detail, but the idea is that's a shortcut method of measuring insurance contracts that a lot of registered insurers use that would make your accounting a lot easier, but I suspect that you wouldn't be able to apply them in this situation. I think you'd have to go through that full general model to actually get a measured amount. Also, you'd probably first say, look, compared to this example, we don't have any premiums. So if that's the case, as I mentioned before, if you've got no premiums, you're assuming a liability, that contract's probably going to be onerous and you're going to have a contractual service margin of 0. So there's not going to be any profits to be recognised. It's just purely a liability to unwind. There will potentially require some input from accounting, corporate finance, actuarial services if you go down that route. Now, it doesn't matter which measurement model you pick, you're going to have to still do this. The existence of the contracts and the significance of the risk, that's where the accounting comes in. When you start to look at the corporate finance, they'll be bringing you in on the discount rates, but also that the actuarial service is potentially looking at things like cash flows and actually quantifying them. And you need to be aware that IFRS 17 is like a live model. Every year you have to update your assumptions and update your numbers to ensure that they reflect market. Now, another thing I mentioned there that, and I sort of skipped over it because it's probably not relevant to so many in corporates, but IFRS 17 is actually, the unit of account is actually the portfolio of insurance contracts, not individual contracts. I don't think that matters so much to corporate entities. So if you've only got one insurance contract, it doesn't mean you can't apply IFRS 17. It just means that you have to think about the one contract is the portfolio. So it's just the wording and how it's structured. And obviously, given the amount of presentation disclosure requirements, if you actually had to apply IFRS 17, it's going to have probably a significant impact on the way your financials look, the types of categories and so on that you have. So quickly, I'll just mention, we've got a lot of the materials I've covered today come from our publication, our Corporate Reporting Insights publication. So I've given you a list of those publications, the particular publications that those articles are in. We're going to continue to working through some of the issues. I think next month I'm going to be writing an article on how do you deal with an onerous contract that has assumption changes over time, and then we'll look at things like the premium allocation approach and the other measurement model within the model that within IFRS 17, which some insurers can use. If this has actually triggered anything that you think you'd like some more information on, what we're doing at the moment is actually doing a bit of a straw poll for people. So there's a link there that if you're interested in and you'd like to do, maybe if you think that you could get some more out of webinars on IFRS 17, would really recommend that you perhaps go to that link and actually just register your interest in it. We're not going to hold you to anything. It's really just to give us an idea about whether anyone's interested in further sort of aspects on the standard, and particularly what maybe things that you'd like to talk about or you'd like me to talk about. So it's there. Certainly, if you're interested, please use it. We are looking to include this work on IFRS 17 as a part of our audit readiness campaign. So as a consequence, so if entities are concerned that they might, for example, have insurance contracts, but they haven't accounted for them previously, getting a position paper on those contracts and understanding whether or not they are insurance contracts, and then understanding what the next steps are. It's something that I don't think a lot of entities have really considered in the past. I think, as I mentioned at the start, it's really been, the idea of insurance contracts is something that a lot of entities sort of regard as the world of the regulated insurer. It's not something that the corporate entity does, but in essence, we do it a lot of times. We do provide promises to people and entities that we need to actually deal with. And I think, Aletta, you might have wanted to jump in here and talk about some of the other services that we provide.
Oh, when you hear the dogs, Aletta is about to start. I've unmuted myself a little bit too early. So Dean touched on the audit-ready services that we are providing, and we've got a lot of clients currently starting to think about the 30 June 2022 audit and saying, how can we get ready? Maybe it's accounting position papers, maybe it's reconciliations. A lot of entities looking at transitioning to general purpose financial statements for the first time for 30 June 2022. So I know Dean's got a lot of work in that specific transition phase. So again, if you have previously prepared special purpose financial statements, and you're now transitioning to general purpose financial statements. It's not a quick and easy process. We have to at least do a bit of a health check. Maybe it is quick, but we need to do a health check and look carefully at your financials, your special purpose financials. If you've previously done general purpose under RDR and you now have to do general purpose using simplified disclosures, again, please reach out so we can assist. What I also have on this slide is lease accounting. Dean, amazingly, and Dean predicted this years ago, amazingly, we're continuing to get people who are saying, you know, lease accounting, you know, it's a big pain. It's ongoing pain. Please help. Now, even entities that have hundreds of leases are coming forward and saying, we've been doing it in somewhat of a own built model in Excel, and they're finding it's just not sustainable to do reassessments, modifications, COVID adjustments, terminations, etc., in Excel at that scale. So please reach out to talk about our BDO lead solution. And I would say the best thing about BDO lead is there's no workarounds. Everything goes into BDO lead. We don't have to fuff around. And then the other thing is lease management services. If you have not that many leases, let's say up to around 200 leases, you know, just pass the hassle off to our team. They do this every day, the whole day, and they can manage your leases quite affordably. They will still use BDO lead, but it won't be that expensive because you don't have to have your own deployment, etc. Dean, then the other thing you moved on to is we've got our monthly IFRS and corporate reporting webinars, and today we've looked at insurance contracts. If you want to register for the rest of the year, please do so. The May one is always very popular, where we look at getting ready for 30 June 2022. But please join us every month. We've also included or started, as you know, a new webinar series on ESG and sustainability. We've started off by scheduling 6. The first one was earlier this month around the ESG process, and now we're stepping clients through all the things they have to do to potentially issue a sustainability report when they issue their 30 June 2022 financial statements sometime in September and October. So please join for those, and if you've missed the first one, you can watch the recording. And I think then the final aspect is please register for our monthly corporate reporting insights newsletter or publication. You know, I know this month's publication is being issued today, later today. We've just been waiting for this webinar to include it in there, but we've got 12 articles, high quality, latest developments around ESG, sustainability, IFRS, not-for-profits. So please look at that publication. I think it's amazing, and register to receive it. I think the final comments is, Dean, thank you very much for enlightening all of us on IFRS 17. I think there's a few things to think about. If you've got any questions, please reach out to any of us, the IFRS leaders, or in particular, please reach out to Dean, because if you contact us about IFRS, we'll contact Dean. So you might shortcut the whole experience and go straight to Dean. But thank you very much, Dean. Thank you, everybody, for joining us.
Thanks, everyone.
And we'll speak again next month. Dean,
Bye,
unfortunately, you'll speak to me later today, but the attendees will speak next month.
We will. Okay. I'll speak to you soon. Bye.